Hello, good evening, one and all. It feels like it's quite late, but actually it's only 6:15. I'm really happy all of you, took time off work early. That's a good thing, right? Or, rush down from wherever you are working at to come and join our event. My name is Andrew. I'm with ASN, and I'm very honored to be your MC for this evening. But I'm not the main guy. Our main guys and ladies are all right here in front, and we'll introduce them shortly. So why are we here today? Last year, we introduced a series called Funding Insights. And it's all about money, right? So this year, we're even more explicit. We're calling it Money Insights. It's the first of its kind. Hopefully, with this good turnout, with a successful dialogue this evening, we'll continue more of this series. And what's Money Insights all about? It's really about not just saving, but investing your money, making your money grow, making your money work for you. But hey, don't hear it from me. The experts are here to share how to do that, and obviously why we need to do that, right? I'm here to introduce ASN to you, to share with you what's going to happen this evening. And before we go there, I'll do a bit of housekeeping. We have this venue exclusively for our events, including the space outside. But because it's kind of separated, I do invite you to stay with us within each segment. And you will know when there's an intermission, where you can then take a short break, obviously get more wine, and have dinner. So we'll brief you accordingly for that. For the first segment, we're going to cover, besides the ASN introduction, corporate finance. And for the second segment after the intermission, we're going to talk about personal finance. I want to give a shout out to our partners, Gen 5, Endowus, without whom we wouldn't be here. We wouldn't have been able to pull this event off. And also our venue partner, N9. They have very generously offered a complimentary pass for you. If you were to scan the QR code, I'll be seeing you at one of their co-working space because I also work at N9. All right? So for those who are new to ASN, welcome. For those who have been to our events or participated in our initiatives, thank you for continuously supporting us. ASN is a community for the startup network, and we want to be the gateway for anyone looking at the startup space, looking at the venture investment space in the East. So our history started with the pandemic. Back then, it was very rough for everybody concerned. A lot of them, however, got help, right? They received help through government payouts, government support, different associations and such. But startups, founders are a unique group. You are in that position because you choose to be, right? So the question was, who's going to help them? Obviously, it's a question that we continuously work towards. But back then, we had an initiative called Mentor for Hope, started by Elise, to bring together investors, successful entrepreneurs, thought leaders to offer mentorship for startups, founders, and builders. And we have evolved since then. Today, we are a nonprofit that have grown to thousands of founders and investors on both sides of the platform. And we continue to do good work where we encourage learning, networking, even product testing, exchanging of ideas, launching in different markets, all with a grounding, a center of giving back to the community at the same time. And that's something that speaks greatly to me why I'm so passionate to be involved all these years, because we empower the startup space, all of us here, to also contribute back. Large organizations have CSR arms, smaller organizations or even startups, two-man team, three-man team, solopreneurs, they may not be able to leverage on CSR to give back to the community. And what Asia Startup Network does is to help them do that. So this is what we stand for. And we have fundraised more than 200,000 to date through several charitable initiatives. It's not just about fundraising, it's also about raising awareness for meaningful causes. And it's also about giving hope to the next generation, to a new wave of entrepreneurs. This is our latest initiative, launched this year, ASN podcast called Rising Up. has featured successful entrepreneurs, also our founder, Elise, in 3 episodes so far, with more to come. I invite you all to watch on YouTube or listen on Spotify. And what we aim to do here is not just to share their experience with entrepreneurs, but also to uplift anyone who's interested in an alternative pathway, because that's what entrepreneurship is. And if you ask those who have been there, done that, they will tell you it's not necessarily a traditional or conventional career path. In fact, some call it a lifestyle. So we just want to give this interest, this opportunity to those who may need a leg up in their future to come and join us. Our team and partners are made up of very dedicated volunteers and well-meaning, like-minded, similar values organizations. So we are very grateful to have all their help. And these are some of the events we've organized before. And you can see Endowus have been a very fervent supporter for us. So with this introduction of ASN, later we'll share our links as well. Do follow, like, engage with us online. But we also invite you for collaborations so that we can grow this community and into an ecosystem, and we can magnify our impact as one startup network. So without further ado, I want to invite Elise. Sorry, give me a second. All right. Sorry about that. Just a friction with the flow. Now I'd like to invite Dom from Endowus, and he will be sharing with us the solutions that they provide. And we are very, very privileged to have you here with us. A round of applause to our first speaker.
Thank you for the very kind introduction. My name is Dominic, very happy to be here and meeting all of you. I've met many of you just before this event. You'll be seeing a little bit of me today. I think I'm scheduled to speak at least one more time. But anyway, this topic right now is about what you can do with your corporate's money. We have another topic later on about individual money. So I think both of these areas we would like you to consider us. Maybe with that, let me introduce Endowus as well. We are Singapore's leading digital wealth advisor for individuals as well as corporates, we believe. And for the individual side, we're the only ones where you can invest CPF. So CPF, cash, SRS, all in one source. 2 main products. So we cater to a broad range of investment needs, if you will, ranging from someone who wants us to basically do the entire thing for them. We call it advice portfolios. We have constructed advice portfolios for people, which is tailored to your risk tolerance and your time horizon. Or you could be a little bit more sophisticated, which is kind of how I started as a client on Endowus. You can also build your own portfolio. Across all this, you'll find that our business model and our capabilities are quite unique, but we cater to quite a broad range of investors. And this is our motto, which is to help everyone invest better, live easier today, better tomorrow. Right, but today's topic, at least for now, we're going to start talking about corporate treasury. And so for corporate treasury, the first question that often comes up is why invest? This is a different answer for individuals versus for corporate, where I think the need to invest is not as clear. So let me try to give a few pointers. I think many of you, as I spoke to you guys here, some of you are business owners. I haven't yet met a treasurer, but treasurer is in charity, treasurer is a volunteer role, obviously. Finance directors, I think some of you here might be as well. So what we understand, I'm the CFO at Endowus. I'm also a treasurer on a non-profit. We play many roles in this finance function, right? Everything ranging from obviously financial oversight, FP&A, management, compliance, risk management, reporting, investors, internal stakeholders, external stakeholders, and so on. And then somewhere in there, there's this whole topic of how do you invest your own money, right? Somewhere embedded in there, normally not top of mind. but it's kind of like, if anything, it sits within the responsibility of a CFO, a finance treasurer, financial director, treasurer, and so on and so forth, right? But that's something that's always there, but doesn't normally occupy the front of your mind, really. But it's actually very important. This is a slide that we put together for charities in particular, where many charities don't invest their money. They raise funds from donors, obviously, and then they keep it very, very tight because this was hard-won money, right? But there are a number of reasons why you should invest, and that's in addition to things like it's quite self-evident. The inflation is quite high, and if you don't invest, actually, the money that you have raised, whether from investors, from donors, will just diminish in value. So the first and foremost reason for investing is to keep pace with inflation. That applies both to individuals as well as to corporates as well as to nonprofits, but that's very, very important. But there are also a number of reasons why you should invest. But the next question that I often get is, what are the investment options that are available for corporates? Because they're often slightly different from what's available for individuals, right? Now, this is a little bit small. I don't know if we can circulate this afterwards, but let me quickly talk through kind of the key options as well as some pros and cons. So on the left-hand side, we start with fixed deposits. I think everyone here understands what a fixed deposit is. You put your money aside for a fixed amount of time, try to get the best rate, open a bank account with whichever bank. Not as easy for a corporate versus an individual to open bank accounts, but certainly you can open a bank account and try to do a fixed D. Your money is locked up with anything ranging from, I've seen as short as 1 week all the way down to over a year. And typically with a lot of penalties, including losing all your interest if you break early. So you lose flexibility, but you typically get a good rate, and everyone understands this. And most companies and nonprofits as well can all do this because it's a very well understood product. As you move to the right, EMMC, I think many of you may not have heard about this, Enhanced Money Market Certificate. So this is basically a structured product that a bank would offer you, where they say, oh, your underlying exposure is maybe this fixed deposit from this bank, but it's wrapped by UBS, for example. So UBS will sell it to you. The only thing I would caution you here is that I had previously been in banking for a number of years. This is basically a structured product. You are taking on credit risk on the issuer. So just like what happened in Lehman, the underlying credit worthiness of the institution issuing it is actually quite important. And effectively, you're getting a slightly higher yield, but nothing is free. You're taking on some additional risk. Although you might say certain institutions are safe, if you recall, just moving back to last year, events like Credit Suisse and others, Silicon Valley Bank, these are all still in recent memory. Moving to the right, T-bills. I think a hot topic for the last 2 years at least, when rates have come up quite a bit. You can also do T-bills in a corporate. You can open an account, you can do it with many banks. The only thing to be especially worried or concerned about is that you have to be able to hold till maturity, because the liquidity during a 6 month, usually 6 months, 12 months, during that period is actually quite poor. The spreads there's a lot of fees. So if you buy and hold till end, it's okay. But in other words, it's a bit like a fixed D. The way you should treat it is really a 6 month or 12 month fixed D, perhaps with a better rate depending on the environment. And then moving further along, single bonds. So you can buy a bond, right? Bonds can give you a higher yield because you're taking on credit risk as well. The other implication of a bond when you hold it, depending on your accounting and all that as well, there is mark to market, meaning that the value of a bond doesn't fluctuate in a straight line. It moves up and down depending on interest rates. And primarily interest rates, but also the credit worthiness of the bond as well. So, depending on how you report and all that, this could pose some challenges. And then I move to the final one, which is money market funds. I presume most people here will be familiar with it, but just very briefly, these are funds that hold very safe cash-like instruments. So the ones that we have on our platform, this is basically what we offer for corporates. The funds that we have on our platform typically hold fixed deposits and T-bills, so highly safe, very liquid, and with very limited volatility. But at the same time, because it's a money market fund, you have full flexibility. You can sell anytime. In fact, I put here T+3 settlements, actually T+2. We've improved it. So you can sell something today, and you get the proceeds in 2 days. But at the same time, you're not giving up any yield, in the sense that you are able to get 3.5% quite easily in Sing dollars, 5% in US dollars, while holding relatively safe instrument and not giving up flexibility in terms of being able to liquidate when you need to. So anyway, we'll come back to this a little bit. I just wanted to share what the rates are. I kind of gave the headline away. Sing dollars typically something like 3.6, 3.7. We always quote numbers net of all fees, fund manager fees, our fees, because we want to represent accurately what you would expect. Rates, of course, fluctuate over time. This is the current yield that we see. But of course, as the instruments roll off, depending on the interest rate environment at that time, your renewal would be, the fund manager as they roll your instruments, the rate could fluctuate, right? And US dollar, you can get more than 5%. I think it's quite attractive, particularly for companies that fundraise in US dollars. That's you don't have to convert to Sing dollars. You might as well. One option that you have is to keep it in US dollars and earn a higher rate and convert when you need to. Right. So with that, I actually have one more topic just to wrap up on, which is to consider using us for your treasury management or your treasury solution, right? And just to give you the quick summary, we offer money market funds as well as investment products that we can tailor to your needs. We dedicate an RM to you, so you have a corporate advisor you can reach out to. We are digital first, but we're not digital only. So very similar to what you might be used to with a bank, we also have somebody you can reach out to for help. When you open an account with us, you also have a custodian account with UOB Kay Hian. So it's really it's also in your own name. So it's double layer of safety. And finally, we have a very attractive FX rate. So as I mentioned earlier, if you fundraise in US dollar, let us help you to generate a high yield on that US dollar. Allow us also to help you do the FX. Because what we do is we pass on HSBC's wholesale rates to you without taking a spread. It's really to help facilitate investments. And with that, I'll give you one last call out, which is for those of you, obviously, thank you for coming today. If you scan the code and give your details to us, if you do open an account with us, we will give you a $500 credit to start in the account, just as a thank you. All right, thank you very much.
Thank you, Dom. This is a really attractive offer. And spoiler alert, there's going to be another one in the next session. So can I have a bigger round of applause for Dom? Because we are very grateful to have the CFO of Endowus here with us. Even more so because he just injured his leg 1 month ago, and he was just off crutches earlier this week. So if you see him walking off later, he'll actually be a bit limping. Do make way for him. But thank you so much. Thank you so much. And now I'd like to invite Jeff, CEO and founder of Gen5, to share with us all about what his business does and how they can help us. And he deserves a big round of applause as well, because yesterday we were busy preparing for this event and he fell under the weather. So today he's really being a chairman, pushing through that. A round of applause for Jeff.
Thank you. Yes, I want to apologize in advance if I sound a little tired or my voice is raspy. Had a pretty rough day or two. First of all, I want to thank the organizers. Thank you so much for the event. I think it's great to see so many faces and so many people come together. And hopefully there'll be a lot more events like this in the future. So for my section, I'm going to keep things very basic. I'm just going to cover some of the key points that are related to financing in general. Some of you guys might be business owners. Some of you guys might be finance directors. Some of you guys might be non-finance people. And so rather than being very, very detailed about financing, we'll keep it very high level, and you're welcome to ask questions afterwards. So this is me. I've been an entrepreneur for close to 10 years now, and the first half of my startup journey was actually in a very different world. So I used to run a startup called GuavaPass, which was a fitness subscription service. Oh, sorry, can you hear me better? Okay. I used to run a startup called GuavaPass, which was a fitness subscription service We were live in 12 markets across Asia and the Middle East. And it was basically an aspirational platform for people that loved yoga, Pilates, spinning, and group exercise classes in general. Afterwards, I sold that business to ClassPass and then basically continued my journey as an entrepreneur, starting GenFi. So GenFi is essentially a fintech lender. We provide financing to digital native companies in Southeast Asia. In terms of financing, I've been through quite a bit. I've raised money from angel investors, from individual family offices, all the way through to institutional funds. So from VCs and doing Series A and so forth. I've also raised debt equity or debt capital from convertible notes to venture debt to institutional financing. So if you guys have questions about financing in general, I'm happy to answer more down the road. Fun fact about myself. So I got into the startup journey when I was introduced to the founder of MySpace. Not sure if you guys remember MySpace. This is pre-Facebook. And at that time, he was starting a women's fashion e-commerce company called Beachmint out in Santa Monica. So I was actually out there for 3 years. I was alongside him, and it was probably one of the most interesting startup experiences of my life. In terms of my career, I used to be in hedge funds. So I've been at a credit hedge fund for a bit of time, and also unfortunately worked at Lehman Brothers before they went down. So this is who we are. So GenFi, just so you understand a little bit about ourselves, we've been around for close to 5 years. We're live in 4 markets: Singapore, Vietnam, Indonesia, Malaysia. We funded over 600 plus clients today. And it's a very diversified client base. So these companies that you see here range from e-commerce to like marketplaces, mobile apps, subscription SaaS companies, and so forth. And we've been very fortunate to have had the right backers, throughout this journey. So we went through Y Combinator very early on. We were the last physical batch before COVID hit. So that was a very interesting time. And then Monks Hill is one of our sort of big investors, as well as Headline Asia. So the basic questions here, business financing, right? It's very complicated for some people because you start diving into all these nuances, and it's very complex. But when you really just take a step back and just think about what are the high level questions that I'm actually asking, it actually boils down to these basic questions, right? What type of financing am I looking for? Like, what are the requirements? Like, does this require me to have certain types of revenue? Do I have to have collateral? Do I have to have something, right? So whenever you're thinking about financing, you have to understand what are the requirements to get that financing. And then how long does this process take? So this is one of the things where, we don't really think hard about because we just want to get money. But some of these processes take a very long time, right? If you want to raise money from equity investors, it could take anywhere from 6 to 12 months these days to raise money. And it's very taxing on your team, on your own time. So this is something to always think about is, do I want something that is quick or do I want something that takes a long time? And then most of these questions on the left side and the first one here on the right side, it's all about now. But really, another big question that we forget to ask, and I went through and made the same mistakes myself, is how will this affect the future decisions that I can make? Because the second you take on financing, there will be strings attached to it. And this can be in the form of what you can do in the future. It could limit your options or it can expand your options. And so you should be very mindful about lenders or investors pitching you, because whenever you take money from them, there's always caveats in terms of what you need to do. So this is a key point that I want to emphasize is when you're thinking about financing, be very, very prudent about what makes the most sense for your business. So here's the concept of risk versus cost. This is a very simplistic view. And as someone that's borrowing money, you're usually on the left side where you're just thinking purely about costs and how do I keep my costs down? How do I borrow money at the lowest possible rate? How do I just minimize whatever amount that I have to pay back to the investor or lender? But you have to take a step back and understand, why is it that they're charging you these rates or these amounts? And the main reason here is because the people that are giving you the money, the institutional providers, are thinking about things from a risk perspective. They're thinking about, how risky is it to me? Am I going to lose my money when I give you money? And the more risk they believe is there, the higher the return that they require. And that's the reason why they charge you more. And this is the same reason why, a multinational company would have low rates for lending, or for low rates when they borrow money, and why maybe your business would cost a lot more when you're borrowing money. It's this very simple concept of risk. And sort of within this risk spectrum, even as a company, there's different levels of risk depending on the type of investor that's coming into your company, right? So if I'm a lender to your business, I'll accept a lower interest rate, for example, because I have perhaps potentially collateral, I have a means of repayment. If I am, sorry, um, if I am an equity investor, I'm going to have to require a much higher return on investment because it's riskier for me. I get paid back after the lenders get their money. So even within the same company, the level of risk can vary depending on the type of instrument that you're using. So this is something to be mindful of. And this is one of the reasons why, yes, you can comparison shop, but when you're comparing with your peers or other companies getting different rates, you may or may not be in the same boat as them. And that's why your offering might be different. So once again, the fundamental question here is, what matters the most? What matters most to you? And when you think about this simplistic kind of notion of debt versus equity, these are sort of the main points, right? So why do you choose to borrow money in the form of loan? Well, one reason could be because I don't want to dilute my cap table. I don't want to give up ownership of my business. I don't want to give up board seats. I want to just be able to borrow money, and then one day when I repay it back, I'll no longer have to be, you know, obligated to this person or company anymore. And it's very clear what is repayment. So these are very simple reasons why people choose debt. And on the flip side, why do you choose equity? Well, maybe you're looking for permanent capital. You want to raise money from investors, and you don't want to necessarily pay them back right away. You don't want to deal with the pressure where I have to make monthly installments back to this lender. I don't want to pledge collateral, or I don't want to sign personal guarantees. So there's a lot of reasons why you might choose equity. And lastly, something that a lot of people don't think about is equity investors. They tend to be quite sophisticated, like venture capital folks, and they have they have a very deep network of professionals, a lot of strategic contacts, partners, and they actually help you in the future in terms of networking. Also gives you validation as a company to have the right type of investors come in. So there's a lot of reasons why you actually do want to give up some ownership in exchange for some of this upside. But at the end of the day, whatever route you choose, you'll still give up some control, right? So even as the borrower, you give up control because there's rules that are attached to the money that you're borrowing. This is in the form of a financing agreement, debenture for lenders, for example. There's rules where they tell you what you can or cannot do. For example, maybe once I sign a loan agreement with them, I'm not allowed to sell any assets over $100,000 without my lender's permission, right? So there's always strings attached with taking people's money. The second thing is, if you're an equity investor and you raise funds, you might have a board member that's joining. You might have investors that are coming on. They're going to have the right to vote, the right to kind of dictate what you can or cannot do. Obviously, you want to find the right partners that can support you through your growth, but just keep in mind that once you have investors, you're accountable to them, and you have to make decisions based on everyone's best interests, not just your own best interests. And then lastly, there's a lot of reporting obligations with either route. And so there's just a lot more work. You're going to have proper financing, a proper bookkeeping, and be able to, report regularly. So just moving quickly to how GenFi came about, right? So we realized these pain points for all these different products, and we launched what we call revenue-based financing in late 2019. It's first of its kind in Southeast Asia. And essentially what we did was we realized that a lot of these really interesting digital companies, like startups, high growth companies, didn't necessarily get the right type of funding or couldn't get access to capital. And the reason being is because a lot of these institutions were relying on very traditional kind of underwriting, traditional data points. So we built an online digital lending business where we are able to use a lot of alternative data, like payment processor data, merchant data, like from your Shopify account, from your Lazada accounts, for example. And by using this data, we're able to understand your business and provide, an offering that might make sense. Because of our background as startup individuals, we understand a lot about their pain points, the types of things that they need, and so a lot of our offering is very tailored to these type of digital companies. And lastly, the most interesting thing here is flexible repayment. So revenue-based financing basically means that when you give money to the company, they pay you back in the form of a percentage of their future sales. So it's very different from a traditional loan where you just pay a fixed amount. This is actually based on some percentage of whatever amount of sales that you're generating in the future. Um, so what we really believe in is funding productive activities. So these are activities where when you spend on it, it'll generate more sales and revenue for your business. So classic example is Facebook advertising, Google ads. If I'm a consumer business and I spend on advertising, hopefully I'll get more customers and more revenues and so forth. And that is a positive sort of reinforcement where I can keep growing as I spend on the right productive activities. On the flip side, one of our observations has been that a lot of companies, they end up spending money on the wrong things, right? When they borrow money. So if you have $10,000, for example, today, are you going to spend $10,000 on very fancy office rent or $10,000 on Facebook ads? And if you spend it on the rent, you're not going to see your money back, right? If you spend it on the ads, at least you could generate a positive return on your capital. So our philosophy has always been in funding the positive growth activities, and it kind of creates this virtuous cycle of growth, which they can then take on more funding and so forth. So how it works in practice, very simple. Let's say we lend you $100,000. You're an e-commerce business. You spend that $100,000 on Facebook ads. The only thing you have to do is basically pay back the amount plus the flat fee. So $115,000 in this case. And then it's paid in the form of your sales, right? So depending on how your revenues fluctuate month to month, you're just paying that 10%. So if I have 160,000 revenues, I'm paying 10% of that. And the beauty of this model, of this flexible repayment model, is that in bad times, I'm actually paying less, right? So if I was a typical lender where I tell you have to pay me $10,000 every month, what if my business was $100,000 in revenue and dropped in half? That $10,000 that I have to repay would have been 20% of my entire top line. And that's very damaging to me as a business. And so we always believed in aligning with the business performance, because if you're not doing well, then you should be paying less during that period so that you have more leeway. And when things are going well, you have a lot of excess cash flow, then yeah, you should just pay more to pay it down. So that's how dynamic or revenue-based financing works. Is it's dynamic and it fluctuates based on your actual business performance. So our process is very straightforward. We're a pure digital lender. You go to our website, genfi.com, you create an account, you connect whatever accounts you have that can generate revenue. So if you have QuickBooks or Xero, like your accounting software, or you have Shopify, which is a merchant platform, or if you have a payment processor like Stripe or Braintree, you basically just connect all these accounts, and then we do all the work in the background. So within the same day or the next day, you'll basically get some kind of offer from us in terms of how much money you qualify for, what are the terms, and then you can just decide on the spot. So this is a lot faster, right? 0 to 1 days. It's a lot faster than your traditional financing, which if you were to raise money from VCs, it would take 6 to 12 months. From venture debt guys, 3 to 6 months. From a bank, it would take up to 3 months. Basically, from anyone else, it would take you a long time, and we can give you money in the same day. So that's really one of the big value propositions, is sort of this instant financing. And And then lastly, just very simple things. You just have to be a business that's generating revenues. Our product tends to be 3 to 12 months in terms of the sort of target tenure. We have different rates depending on sort of your credit worthiness. We currently do deals from as small as 50,000 or 20,000 all the way up to 500,000 US. And you have to be at least some kind of established business, not a pre-revenue business, given that we're basing everything on revenues. But other than that, it's actually very straightforward in terms of our process. So that's all for today. Vernis, who is in the room, raise your hand behind you, is here. So she's also someone that you should connect with after this presentation. We do have a special offer for everyone that's attending today. If you apply and go through this process and mention that you went to this event, we actually would be able to give you guys a rate that is below market. So thank you everyone for listening.
Jeff, thank you so much. A round of applause. Lots of gifts today. Thank you. We'll invite you back up later. So Vernice from Gen5 is here. Zach, are you in the room? Zach and the Endowus team. Yeah. All right, they're all in the back row. You can reach out to them if you have questions as well. Now, we are excited for the panel, aren't we? I'd like to invite Elise Tan, Director of Communications and Community at Vertex Ventures, and our founder of ASN, to introduce our very own mapping of this space and to moderate the panel with Jeff and Tom shortly.
Thank you, Andrew, and thank you again, Dom and Jeff, for coming. So I'm just going to, I think for our events, we focus a lot on knowledge, and we really want to make sure that you have a tangible takeaway today, whether you are an aspiring entrepreneur or you're already started something. So, but I'm sure some of you are really expert in the space. So if there's any mistake that I make, please let me know. So we kind of divide. We want to map the financial products that are accessible to startups and SMEs across the 3 different buckets. Yeah. So obviously, for all entrepreneurs, right? You must have heard of a personal loan. You must have heard of a startup loan these days. And the great thing is that the government is supporting and quite a few organizations are supporting. It could be unsecured. Of course, there are secured bank loan, which we don't advocate, like mortgage, financing your mortgage, and also using your car as a collateral. And of course, grants, I think quite a few of you might have gone to Enterprise Singapore and apply for grants. And then you may also be looking at angel funding. And in fact, we have quite a few angel investors in the room, so do a network well later. And last but not least, of course, like funding and from friends and family. So this is something that everybody can access, right? But as you kind of grow in your entrepreneur's journey, you realize that you can access more products, right? Because like what Dom from Endowus mentioned, it's all about managing. The investors are always about managing risk. So of course, in terms of equity-based kind of financing, it will be from venture capital. For me, I'm with Vertex Ventures. We usually invest at Series A. And then there's also debt-based, which Gen5 is in the space. There are also the usual that you may have heard of, business line of credit, unsecured term loan, supply chain financing, and quite a few. Yeah, so these are the products that will be available to you as you make revenue. And then if you are making more than 10,000 a month, you're trying to see if all of you are awake. Yeah, you will get access to venture debt as well, which we don't get to cover this time, but we covered it last year when we did the funding insights topics. And then Gen5, so Jeffrey introduced the revenue-based financing as well, which is really special and interesting. Yeah, so this is our attempt at mapping the space. Feel free to give me your feedback, your comments. We'll try to make this even better so that we develop different guides for entrepreneurs in the early stage phase. Yeah, then with that, I will move into the panel. Okay. Jeff and Dom. Okay, we will have to share mic a little bit. Hope you don't mind. Okay. Yeah. So we are kind of sitting between your food and the next panel. So we will keep it quite brief. But I have a few, kind of questions for both of you. And then if any of you have any burning questions, feel free to put out your hand so that you can also get your questions answered. Yeah. So originally I want to ask both of you about your background, but I guess that's kind of covered. Yeah. So I also want to jump more into the questions where it's either specific to GenFi or Endowus. Yeah. So I'll start with Dom first. Yeah. Yeah. So I think from your presentation, you bring out a good point about financial stewardship. Yeah. So I think, as we look at, I think, people think about entrepreneurship differently, but I think that entrepreneurship is also a way of stewardship of resources, right? So when it comes to financials, is there a rule of thumb regarding how much percentage funding would you usually set aside for future needs and growth, inflation protection, emergency funds for startups?
I can give some guidance on this. I think the rules of there are not really any rules of thumb. I think for corporates, for individuals, I mean, when my colleague Lin Singh was here, we'll talk a little bit more later. But we'll talk about things like having 6 months of expenses and all that kind of stuff. Doesn't really apply for corporates because it's very different, very case by case. So the way that I've been taught and how we also advise is that you break your money up into chunks based on when you need it. Right? There's going to be money you need in the next 6 months, 6 to 12 months, let's say. There's going to be money you don't need for 1 to 3 years, and perhaps money that you won't need for beyond 3 years. This applies to corporates, nonprofits alike, right? And then what you do is based on the time horizon, you take the risk that's appropriate for that time horizon. If you need money in 6 months, 12 months, you better use a safe instrument, whether it's a fixed deposit, a money market fund, something that doesn't fluctuate so much in value, earns you a yield, but doesn't fluctuate so much in value that when you need it, you have a shortfall. Then you'll be in trouble, right? But at the same time, for that short-term money, but even for your medium-term money, you want to maintain some flexibility in case things change, because things always change. Your ability to forecast is also never perfect. I'll give you an example. So 2 years ago, of course, every year we do a forecast. 2 years ago, my founders came to me one day and said, "Oh, we're going to do a cash acquisition," right? So then all your plans thrown out the window. So you have flexibility. You can liquidate your investments and all that. Then that's fine. So you still need to maintain some flexibility, even if you can't always extract the highest returns. But you give up some of that to our flexibility. Now, for your 3 and up money, you can then do some proper investments. And when I say proper, I don't mean take crazy risks, buy crypto, or whatever it is. I'm not even saying buy equities, but buy a balanced portfolio. Oftentimes, we see, actually, this is quite interesting to me. Even charities invest their reserves, and some of them invest in equities and bonds. But I would say generally towards the safer side. Yeah. Sorry, long-winded answer. It depends is the short answer.
Very informative. And since Jeff in the panel, do you have what do you think? Is there a rule of thumb pertaining to rainy day fund? Yeah.
I think first of all, you have to understand what stage of the business you're in, right? So if you are in the startup stage where you're burning cash, negative cash flow, cash runway is the most important thing because it's your lifeline. And you never know when you're going to reach zero, right? So I think in general, we try to be as conservative as possible to make sure we minimize costs and make sure we have at least 12 months of cash runway to operate. But I think once you become more profitable, then you no longer need to be as stressed about making sure you have that type of buffer.
Yeah, I think it's a good reminder about having the 12 months to 16 months of runway. And that also, if you are seeking venture capital funding, there's something to keep in mind. And sorry to say, a CEO's almost full-time role is to fundraise all the time if you are venture capital back. Yeah, so there's something to consider if you are aspiring entrepreneur. I also want to go back to Dom. Yeah, so I think that the money market funds that Endowus offer is really flexible, is really useful because when I talk to some of the entrepreneurs and I ask them about how do they handle their funding, how to make sure that the money really stretch for them, I think most of the time they mention about fixed deposit, right? So and that can be quite. If you look at maybe you want to get the highest interest, usually there's like 12 months, and that can be quite scary when something like a black swan event happen. Yeah, so I'm curious more to know more about the money market funds. You know, is there something that actually entrepreneurs can assess themselves? You know, instead of going to Endowus. Yeah.
Like what else? How can they do it? Okay,
How
you
can they do
can.
it?
I mean, I guess this really boils down to kind of what's the value proposition. But thanks for the interest in our product. I hope you also scanned the code earlier. Just kidding. Money market funds are actually a very well known, very kind of like commonplace, common investment product. It's a very low risk investment product. It's on the spectrum of investments. You can do it. Obviously, you can also buy funds through banks. This is kind of very well known. But the reason companies like us exist is because banks are very expensive. They charge you a sales charge. If you put in 100,000, you will only get 98, 99,000, depending on the bank and the channel. But on top of that, what's less known is that funds also have different share classes, and share classes are basically cost, right? Different cost levels, if you will. And the ones if you go through a bank, because the bank needs to be paid, and in addition to taking a sales charge from you, they will take some money from the fund manager. So they have to charge you more. And that's what we call the retail share class. Because the fund manager will then pay the bank, right? It's a backdoor payment in a way. It's coming out of your asset anyway. What we offer is we offer the lower fee share class typically. And so you would earn more and keep more of the return. So there are many other channels you can buy from platforms. You can buy from banks. You can also buy from us. I think all I can say is compare, like, do your homework, figure out which funds, and then once you know the fund, compare. Yeah, that's what I would say.
Yeah, thanks for sharing that. I Yeah, just you were asking me whether I scanned the code, right? So I was wondering whether I actually even qualify for this. Is there a minimum to qualify for the treasury?
Yes, unfortunately, there is. On the individual side, I just cover this quickly. We have a minimum of just $1,000 because it's a digital platform. It's easy to serve. It's onboarding is 5 minutes. Sync pass very fast, and no humans are typically involved. Like, so we can keep the minimums low. Unfortunately, on the corporate side, and this is maybe the industry is not as evolved as well. Um, it's much harder to open a corporate account. So imagine if you go to a bank, I'm sure all of you have operating accounts. It's quite difficult. So to make sure that it's worthwhile for you, as well as for us, we put a minimum of 500K. If you think about it, 500K at 3.5%, for example, a year, actually isn't even that much money for you. So I think for less than that, it doesn't really make sense for you. Our fees are incredibly low. We only charge 15 basis points, 0.15% a year. So 500K, 15 basis points is also incredibly low. So we put a minimum just to make sure that it makes sense for both parties, and then serve you for long term. Yeah. Thanks for
Okay,
that
thank
question.
you. Very clear.
Do you meet the minimum? Just I won't put you on the spot. Sorry.
Okay. Would like to ask Jeff for the next question. So, you know, I think the revenue-based financing is so interesting because prior to this, I think I heard of more of invoice-based financing. So maybe you can share a little bit what's the difference between invoice and revenue-based financing?
Yeah, that's a good question. So revenue-based financing is more holistic, right? You're trying to use this financing for all sorts of different growth opportunities, and it's based off of your entire revenue stream, right? Invoice financing is very specific to the invoices that you already have, and then you're basically getting an advance off of the invoice. So let's say I generated a sale, I have an invoice, I can go to these type of specialists where I can get money upfront for whatever invoice I've generated because then they'll get paid later on. But I think we like to think of ourselves as more of a broader based kind of use case where you can do a lot more than just funding purely based off of your invoices.
I got it. And I was just having a chat with Ying, who is unfortunately not here today, but I understand that GenFi also offer other products other than revenue-based financing. Do you want to just share with the audience?
Yeah. So one of the other products we've just launched is actually this micro e-commerce financing, which is actually catered towards. So one of the pain points we realize is that a lot of the even smaller, earlier entrepreneurs need a product that is a little bit more retail, like a little bit more mainstream. And we've offered essentially a product where if you're below $10,000 in terms of ticket size, you can still qualify for our platform in a fairly automated fashion. Another product that we launched, but it's not in Singapore. It's in one of our other markets. Vietnam is actually a B2B buy now, pay later. So basically, helping suppliers and helping the supply chain between suppliers and buyers, where you're converting a purchase into sort of 60-day, 90-day terms, very similar to sort of the consumer equivalent of converting payments. So that's a product we offer in Vietnam, which we hope to bring back to Singapore one day.
Thank you, Jeff. Thank you, Dom. I think I learned so much from both of your presentations, and I hope the same for the audience as well. So I also want to take the time to open up to the audience for a few questions. Is there any burning question? Okay, so just to make sure everybody caught the question, I think so. Our gentleman here, he was asking with other assets, right? Assets that are in the market, for example, crypto. As a company, as a business, how do we manage that whole portfolio? I guess in terms of making sure there's cash flow and also the risk. Okay, does that paraphrase well? Yeah. Okay, I just.
Crack at that. I assume you mean for the corporate as a Web3 company? Sure. Okay, sure. Actually, interesting enough, we do have a number of Web3 and blockchain and crypto companies who are clients with us, which is I found that quite interesting because you're not investing crypto, you're investing fiat, obviously. But yeah, it's still an important function. Actually, one of my largest clients is a crypto company. So they're doing nothing more exciting than actually they're just putting money in USD and Sing dollar money market funds, which I find quite interesting. Although they are also considering with interest rates where they are and all that likely to come down eventually to look into a bond portfolio. That's one example. I have another example where they were waiting, this was 2 years ago, waiting for, I guess, prices, entry points and all that in crypto. And similarly, they opened an account with us to get some yield. So yeah, and then when the time was right, they liquidated it and put it back into their core business. So that's one way. Yeah, so we can serve Web3 companies, no issues.
Thank you. Jeff, do you want to add anything for this question?
I don't really have much more to add. I think
Okay.
it's more about just liquidity, right? So you have to understand the reason why you might need funds at what point in time. And I think parking in fiat currency is actually still a very good way to generate yield, and it's safe, and it allows you to time the market for different opportunities. Exactly. Not too many, to be honest. So it's not a space that we're as familiar with.
I think it's an interesting question, and thanks for your answers. I used to be in Web3 fund, so I think the rule of thumb is diversification. And what Jeff also mentioned is about liquidity, right, when you need it, because the truth about crypto sometimes is a lot of fluctuation, right? So you need to think about, as a business owner, need to think about how do you manage the risk and reward, and then the fluctuation versus something that is more manageable, predictable. Yeah, and I don't think there is a right answer per se, because really depends on your business. What is the, maybe even like your account receivable, what number of days, right? So you really need to look into the details. Yeah. So we want to wrap up soon with the last question. Does anyone have a last burning question? If not, thank you so much. Thank you, Jeff and Dom, for sharing.
Thank you once again, Elise, Dom, and Jeff. All right, the best time, the best moment is here. Not yet. We have a photo taking to do because Jeff unfortunately has to excuse himself to recover. I'm going to facilitate the photo shoot with everyone. I'd like to invite the front of the room to stay seated and the back of the room to stand up. Feel free to huddle amongst yourselves, okay? And I'm going to set up the camera. And it's dinner after this, I promise. Let's get the second half underway. For this session, we're going to talk personal finance. We're going to get personal. And we have a very, very dear friend and close supporter of Asia Startup Network who will drive this second segment. I'd like to introduce Diego Tyra. Diego is a dynamic individual with a diverse skill set, serving as an serial entrepreneur, equity investor, option trader, wealth advisor, ICF certified, and Mind Valley business coach. Diego is an ex-IT consultant who retired at 40 years old. Who wants to do that? Yeah. And today, Diego holds the position of CEO and co-founder at Wealth Angels, where he passionately pursues the mission to empower individuals to achieve financial independence, enabling them to pursue their true life's calling by becoming their life CEO. Diego, come on up. A round of applause for Diego. Okay, take it away.
Hello, everybody. I hope you are enjoying and learning today. If you are learning, maybe we do some exercise. You tap, give high five to the person beside you. I'm learning. Good. Okay. If you were looking forward for the food as well, also, and you're still starving, you give another high five to the next person. Say, I'm satisfied now. Great. And okay, so I want to get started first. I'm grateful to be here because my dear friend Elise and also Andrew invited us and making this event possible, and as well as the partners and supporters to giving us free food. So let's give them a big round of applause. Come on. Okay, so as an introduction as well, I am Diego Taira. I also have been, I have fired my bosses at 40 years old, which means financial independence, retire early. It's not about war. So I think that if the money is no issue anymore, I believe everybody can really pursue your dreams, contribute more with the society, with your family, as well as build up your own company, right? Because it's something like, I believe it's a first milestone for everybody to reach. Even myself, if I can reach financial freedom, I believe everybody here can do that. But if you are like me before, I believe that no one taught us about finances, personal finances, how to manage your money, grow your money, keep your money, and I believe not even your parents, your siblings, your teacher, preacher, society never thought about this, right? And it has been like this for generations and generations. It needs to stop here, okay? So if you are, we cannot blame our parents, we cannot blame our ancestors, but what we can do is take responsibility, full charge, and then learn this skill set, which is personal finances. So and be the person or be the change you want to see in your family tree. Okay, so I hope you, after eating, you still here. So tap yourself in the back and stay here for a learning. So I would like also to thank Jack and Lensing. Where is Lensing? Oh, he's there. Okay, I finally met you. So I'm going to introduce the topics of today, and I'm also going to read their amazing bio. I don't have that good memory, so I need to read. Today, we are actually going to cover the first 20 minutes, so 10 minutes each is going to be a sharing about personal finances by Dominic and also Jack. And we are going to move forward around 15 minutes with a Q&A session, panel discussion as well. And to introduce Jack, Leo is one of the ASN leads, as well as he is a serial entrepreneur who successfully sold 2 companies, as well as raised fund around 500 million, $500,000, and expanded into the region here. In 2016, he started with the option trading, and he generated around 36% during the COVID season. Okay, so we are going to learn from him about investing as well as option trading. And Lian Xing is a senior client advisor at Endowus. He's also having a decade worth of experience working with in the industry, in the financial industry, as well as fintech companies. And he's he's passionate about doing right by clients, and with Endowus, he hopes to elevate financial literacy, transparency, and integrity in the wealth management industry. Okay, so without further ado, I would like to invite Dominic first. Okay.
Thank you. Thank you. Like I said, you would see me again, so here I am. Right. Yes, so let me jump in. So now we're going to segue a little bit into personal finances, how you should invest for yourself. So I have a standard set of slides, but I've changed it for tonight because this is a different audience. And here I want to talk about, business founders, business owners, C-suites, and so on. Where in general, I think people expect or understand that you are generally wealthier than the general population. A number of reasons why. The first is that, well, if you are successful, yes, you will obviously get a big share of your company's upside, right? Even if you're not the owner, often there's a long-term incentive plan. So that's also tied to, if you're a successful company, again, you are, this is generally can be quite a large part of your compensation. Also, we find that, maybe this group that here, given your networks, including today's network, you would have access to various types of investment options: startups, private equity, venture capital funds, alternative investments. So these are, reasons why you might be generally wealthier than the general population. However, that doesn't mean that you are necessarily financially savvy. And there's some reasons why. And a couple of them I'll point out. So first is lack of diversification, where your personal wealth is tied very closely often to the fate of your own company. You may have even sunk your own savings into it, and so you live and die really by the success of your commercial enterprise. Some fancy words here, wrong way risk. That basically means, if your company doesn't do well, you're not only losing the value of that equity, but also perhaps your own job. So that's there's concentration, liquidity risk, and all that as well. You could also be overly business focused, leaving very little time for your own finances, and also a heavy reliance on advisors, which is not necessarily a bad thing in itself, except that you have to make sure that the advisor has your interest at heart and is not conflicted. So that's one thing. Now, why should you invest? Again, I've tweaked the slide. Normally, our slide shows the cost of a Ya-Kun set, where it goes from maybe $4 to $5. I forget the exact number, 4 to 5 maybe, right? 20% increase. But here, and for regular folks, public transport has gone up 2.9% in 2021 to 23. But if you're, actually, we're going to play with this a little bit and have country clubs and all that. But just to make the point, your COE, actually, that's a little bit out of date, but it's not too far off. It's still a massive increase. So your finances, just like your companies, you lose value to inflation. So it works the same for obviously your personal money. And if you talk about retirement, as Diego said earlier, you can't rely on CPF alone, right? I mean, it's a very good plan. If you retire early, you have less CPF, but certainly you need to make what you have grow. And growing it's much more than putting in a bank and trying to get an interest. I think that's a very different rate of growth versus investing consistently and in the right way, which we'll touch on later. So, good financial habits. I will take a few minutes to go through some of these points. This is usually the topic of a 45-minute session that we run quite regularly. Lean Sing runs a lot of them. My team runs them too. I will try to give a 5 to 10-minute version. So please excuse me if I speak a bit fast or if, yeah. Okay, let me start with this, which is diversification. In finance, we often say that diversification is the only free lunch. That's because what happens is it helps you to lower your risk while generating a same return, or generate more returns for the same amount of risk when you diversify, because asset classes don't always move together. The slide here is going to be impossible for you all to read unless you have very good eyesight. But let me narrate it to you. So top to bottom, we're talking about returns. So the lines at the top are basically the asset classes. So each color represents an asset class. So the top represents the asset class with the highest return in that particular year, and then left to right, these are different years, 2008 to 2022. Actually, I have a 2023 version. I think forgot to update. But in any case, what do you notice about this chart? Anyone? Lean Sing. Just kidding. I'll give the punchline away. You can't predict which asset class to do best. That's the short. That's the punchline. If you extend it, whatever, it's hardly ever. You can't pick last year's winner. In fact, that's the reason why I'm a little bit annoyed we don't have 2023, because if you look back at recent history, 2022 commodities was the surprise winner. In 2023, commodities was right at the bottom. I don't have that on this chart, but that's why it is. In fact, 2023 it was the very large caps in the US, DM equity that did very well. Developed markets did very well. But the point is, it's very hard to predict. So the only way, or what we say is the best way, is to diversify, hold the whole market across equities, across bonds, across geographies, all the way through. And obviously, depending on your time horizon, the longer your time horizon, the more risk you can take. And that means typically more equity risk. The shorter your time horizon, typically more fixed income, perhaps money market funds. But in all cases, diversify. That's the first point. Second point, I'll try to make this in a more visual way. You guys, many people would have heard of this saying, it's not about timing the market, it's about time in the market. And there are many ways to make this point. We have a particular way that we like to use, which is a hypothetical investor, what we call the worst investor in the world. Worst from a timing perspective. And to illustrate a point and to show how that investor would have done over time. Okay? So this particular investor, I'm just going to call him Zach because I have a team member called Zach, but not that it is Zach, because this example starts in 1973 and he wasn't born at that time. Neither was I. But Zach starts investing in 1973, just before the oil crisis. I say this like I know what I'm talking about. I have no idea what the oil crisis was before I was born, but there was a big crisis where markets dropped 43%. Zach unfortunately buys the market at that point and then loses 43%. He puts in 100,000, just for argument's sake. Basically, if I take a step back, Zach only invests when the market trend is very clear. And as we all know, when the market trend is very clear, that's often just before a fall. So he's burned by that, doesn't invest again for 14 years. But he gets into the market again, another 100,000 on Black Monday. I think it's October 1987, if I'm not wrong. Okay, in between he doesn't sell. He just goes, I don't want to do anymore, but I'm just going to hold on and survive. He puts in another 100,000 before Black Monday. Markets drop 23% the next day or during that period. So same thing happens. He holds back for another 13 years, puts in another 100,000, so 300,000 at this point in 2000, just before .com crash. All right, now this is stuff I'm starting to remember. And then again, another 100,000 in 2007, just before the subprime global financial crisis, subprime crisis. And then finally, another 100,000 just before the COVID crash. Actually, we wrote an article about this in the Straits Times, but we've updated it, including the COVID crash. But the point is, this investor doesn't redeem, doesn't sell. He stays in. He just doesn't invest because he's got bad timing. It's burned by the experience. Takes over a decade. How would he have done? So actually, he's invested 500,000 over this very long period of time. I think that's the key. It's about how long you're in the market. And his 500,000 will have become just short of 10 million, right? And you can't see the numbers here. I think the formatting's going a bit funny, but it's a 20x return or an 8.5% per annum. Just convert to annualized terms, right? 8.5%. A couple of caveats. This is based on indices. There's like no cost and all that, no trading cost, no transaction cost. But just to indicate that this 8.5% is a 20x return versus if you put in a bank over that period of time, even though rates may have been higher over time, that's going to be a very, very different outcome when you have $10 million versus obviously a 500,000 or slightly larger number. So this is the example of the worst investor in the world. Even if you're that person, just by holding in the market, you will have done okay. That's the point. And another way of illustrating that is that, again, this is a little bit of a complex chart, but left to right, we're talking about holding periods, 1 year, 2 years, 3 years, and then on the right-hand side, 20 years. Of course, the shorter your holding horizon, so like, for example, 1 year, you could have a plus 50 or minus 50, right? I think we can come up with examples where, over a 12-month period, we roll the windows. This is the range of outcomes. The longer you hold, the more narrow the outcomes become, both on the downside as well as the upside. You can't get as high in 2 years, 3 years, on a per year basis. You also can't lose as much. And in fact, if you look slightly past 10 years, somewhere between 10 and 15 years, your returns are, historically speaking, always positive. And so that's what we have to think about, which is, again, time in the market, not trying to time the market. Okay, so maybe let me just wrap up. How many slides do I have left? Okay, 2 more. Very good. Let me just wrap up. There are a number of ways you can invest. And the most useful advice I think I can give you today is to think about your investing in specific buckets. Just like earlier when I said that for corporate, think in terms of time horizons. In this case, personal, think in terms of what your needs are. For example, is it a holiday in 3 months? Is it a wedding in 2 years? Is it a house deposit in 5? Is it your, well, I guess the example I gave earlier, your car in 10 when your COE runs out? Is it your kids' education? Is it retirement? So as I give you these examples, I'm going from short to long, right? Why do I say that? Because each goal has its own time horizon, own risk tolerance, and therefore it should have its own asset allocation. You buy different things for different goals. So this example, how do you invest your first 100K? This is a hypothetical example. You could put 20K in a rainy day fund, money market fund that doesn't move doesn't take on too much risk. 25K in a income fund, so high dividend stocks and bonds to generate income. Perhaps 25K in something that you only need in 5 years, so you can take a 60-40 portfolio. 20% in longer term, like 10 years or more, where you're just holding some global stocks. You could do that. And then you could put 10K in something that, what we call satellite, basically place a bet in something that you believe is undervalued. In this example, we give China equities as an example, but could well be crypto, could well be some other asset class that you have some knowledge of, but and want to express your view. And so by thinking of it this way, rather than just one lump, what's my overall portfolio, think about it in terms of your goals. And maybe just to wrap up this example, hopefully more relevant to you guys than the earlier one, this is how you invest $1 million, how you could invest. Yeah. And here, similarly, 50K money market fund, because you want something that is there when you need to liquidate it and you're not worried that it has dropped in value. Perhaps 200K in a passive income. Passive income meaning that you're just trying to generate monthly returns through bond payments, dividend payments, not touching your principal. Perhaps 200K in, again, 60-40, something that you need in 5 years, put it there to grow. And then this example here, 450K in something longer term. And typically, if you have 1 million to invest, you can do stocks, but you also have access to things like private markets and hedge funds. So you could put almost half of your 1 million in liquid assets and something like that to get a higher return for the longer term. And then again, if you have a thematic view, whether crypto or something else, you could put, in this example, we have a multi-strategy hedge fund, which is no surprise, everything I've mentioned here, you can invest on using the Endowus platform, just to give you some ideas. Okay, thanks for that. So with that, who should I hand back? I hand back to Diego. Jack? Perfect, thank you. Oh, sorry, can I just... And maybe you can scan this later as well, but if you want to give us a try with this code or come and see one of the Endowus team members, this will give you a $50 credit in the account when you start. So as a thank you for coming tonight. Thanks.
Let's give another round of applause to Dominic. Hello, my name is Jack. I'm going to share with you about financial investing. Okay, I'm going to use this approach, MITO. It's a very simple approach. Hopefully that you all can remember. Please feel free to take as many pictures or take down notes because I'm going to add a lot of values in this session. Okay, when you come to hear about this investing in the stock market, what actually comes to your mind? Is it like risky, high return, high risk? You know, all this actually are true. It is risky, yes, if you do not know what you're doing. It's likened to driving a car. If you do not have a car license and you drive on a highway, it is risky because you're likely to go into an accident. So it's like the same as stock market. You must know what you are doing in the market itself. Okay, next question is, some of you might be thinking, oh, I might just, wait and buy the dip when the stock market drops. How many of you actually think likewise? No? So if that is the case, I mean, of course, we all know the formula, right? Buy low, sell high. That's the way to make money itself. But if that's true, how many of you actually invest during COVID period itself? Let me share with you what happened during the COVID itself. Of course, we all know that the stock market actually dips. This is my personal account. You can see from the top is 1 year from 2000 January to December, right? The whole year of 2020. I made a gain of 37%. You can see from below. It's not a lot. I mean, I know someone who actually made 100%, but from the 37%, actually, I get a gain of $140,000. How many think that it is not bad for 1 year, right? So this is about going to the market when you know what you are doing. Okay, as I mentioned, right, using this MITO approach, it's very simple to remember what is M. M is mindset. We need to have the right mindset. As what Dominic actually mentioned, this is a very similar slide. If thank you so much. Right, if you can see from this chart, right, you see the whole entire market from all the way from Great Depression, 1930s. No, I mean, maybe most of us are not there. Then during World War II, and the dot-com bubble burst, which is 2000, and as well as the COVID 2020, you can see the trend over a long period of time, the stock market eventually goes up. Although there's a dip, it's true, but eventually the stock market goes up. The compounding effect, let's have some fun. You know, I want to ask you this question. Assuming you just invest $1 in 1 year and leave it there for 21 years, okay, and assuming the interest rate is 100%, of course, this is a hypothetical example. Let's make a guess. Okay, year 1 you put $1, year 2 it compounds to $2 because 100%. Eventually, year 10 is 512. Make a guess, right? At the end of year 21, how much do you think you'll get? Is it A? Is it A, anyone? Or B? Or C? Okay, good. Most of you are very savvy. Okay, year 11 is 1,000, year 12, and eventually, of course, year 21, you get $1 million. Of course, at the back of your mind, you say, hey, Jack, this is hypothetical example where got 100% interest rate. It cannot be realistic. Let me show you something that is more realistic. If you do a search, right, on the Google, SPY is an ETF of S&P 500. Most of you will be familiar with S&P 500. So it's the same. And you do a Google search, the annual return, right, on average is about 10%, 10.26%. This is a free website where you can use the compounding calculator. You can copy the website. I'm going to show you this video. It's very interesting. Okay. Let's say you put in 50,000 as an initial investment. Just now we say that the interest rate is 10.26% per year. Over 20 years, and every month, let's say you were to put in $800, just $800 every month to invest. And we do a calculation. At the end of 20 years, this is how much you get, $1 million. Is it achievable? It is, right? Okay. And of course, the power of compounding effect. What's the secret? Number 1 is to start invest immediately. Maybe not for yourself, but for your children. When they are 21 years old, they can pay for their education fee. Start small and consistent. And number 3, over a period of time. That is the power of investing. Yeah. Okay. After M, right, the mindset, I is what? I is investing into the fundamentals. What do I mean by that? When you look at this picture, what does that tell you? Just now we don't have McDonald's, but over here you can see, right? If you understand McDonald's business, is it just selling Happy Meals, French fries? No, right? Okay, some of you would know that McDonald's are into real estate business, into franchising, right? So when we invest in a company, we must know what is their real business. That makes us different from other investors. This is another free website. This guy is not Warren Buffett, all right? It's an advertisement. Gurufocus.com, it's a free website. You don't have to sign up for this. If you go to this website and you type Warren Buffett, let me show you this video. It's going to be very powerful because you get to know his portfolio, what he owns, what he sells. Okay, you type Warren Buffett, then it will show you his portfolio. And it can be quite recent as well. That will be interesting because not just Warren Buffett, but other gurus as well. And you can actually follow what they are doing. Of course, don't follow blindly. Of course, disclaimer, this is not any stock recommendation. This is just for educational purpose. But this is a very useful website as well to know. Okay, next. Okay, after I, we have T. What is T? T is technical charts. Okay. Of course, when we know about the resistance, support, level, it will be very useful as well in investing. Okay, I would recommend this tradingview.com as well. This is a free website you can use. I use this all the time. You don't have to sign up for this. Let me show you how it works. There is a lot of tools in this, a lot of indicators you can actually use. So over here, right, let's say you choose Apple, AAPL, you go to indicators. From here, you can see all the technical charts, right, you can use. And of course, from here, you can actually put in the moving average. You can know where is the support line, where is the resistance line. So this will be useful. So what I'm showing you is like how you can actually play with it. It's very straightforward. Okay, next I want to cover is options. This will be exciting. O stands for options, MITO, options, okay. What exactly is options, right? This is a very powerful strategy that I'm going to share with you. I call it strategy A. It is sell put, if some of you are aware of this. Okay, let me share with you this video. You can choose any stocks. Let's say you choose Apple. You click in options. You choose 30 days expiry. And under the big column, right, you can choose this amount. Okay, this amount 440, right, or 439 actually goes into your account straight away. This is about selling put options. As straightforward as that. If some of you didn't catch it, right, let me just summarize. Okay, if let's say Apple is trading at $180, when you apply strategy A, which I talked about, you can potentially buy the stock at 175 below the current stock market, right? It's like having a discount, stock discount. And plus, you get an upfront premium of $440. This is the power of options trading itself. This is another website. You can actually go to, it's NASDAQ, where you can actually see what are the options premium. Let me just share with you. Over here, you can just type in the stock symbol as well. Okay, from here, you can see from Apple, you can choose the expiry. Usually, we choose 1 month. Right, 1 month expiry for the sell put. And from here, under the big column, right, you can see all the different premiums that you can actually collect. So options is a lot of fun if you know what you are doing. last but not least, okay, when we use options, 2 rules that we must remember that is very important. You promise to buy the stocks and you must have cash to buy the stocks. This is to protect yourself, and you must know, you must follow these 2 rules. It's like driving, you follow the traffic light. So options, you also follow the same rule as well. It's to protect yourself. Okay, I have this ebook to give away. It talks about the free, it's a free book. It talks about the options, techniques, as well as the strategies. You can just scan and download for free. Okay, I think I'm done for tonight. Thank you so much for your time.
Thank you so much, Jack, Tom. And we are going to move into the Q&A session. Okay, so please move here. And I hope you are taking a lot of pictures. You can post into your social media, LinkedIn, and spread the knowledge as well, so we can ripple this effect. And yes, please come here. Lindsay, yeah. Yes. And please also take notes on maybe your question, so you can ask directly to them. And if you think like you are too shy to ask the question in front of everybody, after this session, we are going to have a 30 minutes networking event. So I hope you can check directly with them. Okay? One more thing is when you take notes, as well as you convert this information, all you have consumed today, you can transform into transformation. And the thing is, one insight can change your life, your business, and your wealth forever as well. So when you talk with like-minded people who are here to learn from each other and improve your wealth, business, and so on, I believe it's going to be beneficial. So we don't need to go through all these journey ups and downs emotionally alone, but you have now a community that you can tap on. Okay? So there is a quote saying, if you want to go fast, you go alone. If you want to go far, you go together. So this is why we are here and then doing this today. Okay? Without further ado, let me ask the first question, and I would like to also open the floor for all of you as well. So this question is going to go for both of you. Walk us through your background and share a few events in your life that shape your personal finance and wealth management destiny.
Thank you for the question. First and foremost, I wish I'm like Jack, like retired at 40. But I'm oh, that's you? Sorry, I wish I'm like you, retired at 40. I'm 41 and I'm still not retired. So my journey is quite interesting. So my name is Lin Seng. I'm a senior client advisor in Endowus. So basically, I report to Dom. I'm here because Dom has asked me to be here. So part of my job is to boss, that's right. Part of my job is to help clients understand the philosophy of Endowus, as well as to help them navigate the platform. So in essence, that's what my job, day-to-day job. My journey to wealth management is quite accidental. So I did a bit of research on Elise. I think she's not a finance grad. You did chemistry in university? Chemical engineering? Yeah. I did science in school. So I would say I'm an accidental banker. So I started my time in finance at OCBC and Citi, where I spent the bulk of my time. Thereafter, I took an unusual route to do religious study in Canada for about 3 to 4 years, and then I worked at a local church before I found my way back into finance. Via Endowus. So to answer your question, the 3 journeys, the 3 sort of events that sort of shaped my journey in finance and as well as my understanding of wealth management is my time at Citi, where I was during the financial crisis, where Citi almost went bankrupt. I'm not sure if you guys remember Citibank at below $1. Some of you might not remember, but that's the very indelible memory, the financial crisis. Second is this discovery of index and passive investing, personally, And third is my sort of providential journey to Endowus, which really just shaped how I thought about finance and how I thought about wealth management and how it can actually impact lives in a very real way. So yeah, that's a bit about my journey.
Interesting background. Okay, for myself, I graduated from accountancy. Then after which I went to audit industry. Of course, you might think that is it because I was in finance, that's why I go into investing, or do you need to have a finance background in order to go into financing? Investing? Actually, don't need. You don't need. Yeah, it's a real life example. You don't need finance. You don't need financing background to go into investing, right? So anyone can actually start. Just that I have a bit of advantage to understand a bit of the technical terms. That's all. So after I was in the audit industry for 5 years, I got bored, so I fired my boss. I started my own business, right? That was in 2010. Then 2014, I started a startup, like many of you here as well. 2016, 2 years later, while I was still in the startup, raising funds, going to different countries, expanding the market. I was also learning about options investing. Why? It's because I feel that I need to diversify my finances, because as many of you know that startup is a very risky business. It's like I would say it's like a game in the sense that the stakes are really high. So you need to keep on raising funds in order to stay in the game. So I realized that it can be quite risky, so I decided to have a backup plan. That's when I actually go into options investing to learn about how to invest. Yeah, that's a bit of my background.
Thank you for sharing. I see that there is also a pattern here. Like when you have a story, like, and I call this like Kensho moment and Satori moment. Which Kensho moment is when you are forced to do something about your personal finances because your company there is a layoff, or you, for example, doctors stop. So you are forced to take care of your health, your wealth, and something else. And then Satori moment are like Jack. Sorry, I don't want to make it winner. But the thing is, when you think like, oh, I want backup, I think you grow by insights, right? And then you avoid this kind of dip, right? Because you are aware of what could go wrong, or maybe what it could be the next step to go further. So if we stick in the same comfortable zone, sometimes you have to pay now or you have to pay later. So now you have the awareness what you're going to do. You have the probability to work with the person who can help you how to manage your money, right? And working hand in hand, or DIY, right? You have to go through the learning and the understanding about stock investment, option, technical analysis as well, right? Whether you are an entrepreneur or you're working for one, I think is not exclusion. Everybody has to master this skill set, which is personal finances and investing. And investing is not anymore an option. We have to do it because the interest rate is so crazy. So everybody has to take responsibility. Anybody has a question for this gentleman? Please raise your hand after I speak.
Yeah, the question, I think everyone can hear. Right? So my first question is, I think earlier I think Dominic was mentioning like because there's so many different kind of asset classes that you can pick into, and of course to reduce the risk, one way is to diversify, right? I mean that's a common term that we all hear: diversify here, diversify there, don't put all your eggs in one basket, right? So on that note, right, when it comes down to diversifying, right, is it suitable for everyone? Why do I say so? It's like not everyone has millions of dollars or my first million bucket that I can use it to fund so many different asset classes, right? Normal working adults, like maybe they started their saving journey relatively early, so maybe by the time when they are ready to invest, they maybe have around, let's say, 100K. So in terms of 100K, is this a good way to diversify into so many asset classes, or is it better to just choose a more concentrated one, maybe in stock, maybe in a certain index? Yeah, what are the thoughts?
I'll take. I think there are. if I hear you correctly, I think there are maybe two questions. I think one is whether you need to amount to have a lot of money before you can diversify. I think that the answer is no. I think, as an example, on our platform, just with $1,000, you can have access to funds that give you underlying exposure to 10,000 stocks, right? So that's, in one click of a finger, with $1,000, you can get diversification. I think your second question would be, because you are building wealth, right? And generally, I think there's some school of thought that you might want to concentrate your wealth and make certain sort of quote unquote bets, and so such that you can get outsized returns on those bets, right? So I think that's obviously that's possible, but I think ultimately, fundamentally, you have to ask yourself, what is the risk reward trade-offs for those options available, right? So I think aside from the returns, you need to look at what sort of risk are you undertaking to get potentially those outside returns. I think specifically for entrepreneurs, honestly, I don't think you want to be worried about the markets, right? As entrepreneurs, you want to eat, breathe, and whatever, your business. You want to channel all your energies into making your business a success, right? And as entrepreneurs, as startup founders, there are only two options, right? Either you can't get funding and then your business dies and then you just become an afterthought, or your business succeeds and all your energy is channeling to making it the latter. So, maybe this is an answer to the question I was going to be asked later, but the reason why we advocate for personal finance literacy for entrepreneurs is such that you can invest in a manner such that it's appropriate for you as a business leader, right? That you can do your investments on the side and you know that it's well taken care of, and you channel all your energies into making your business a success. The last thing you want is to be worried about whether there's going to be another war, whether another conflict is going to impact on the whatever instruments you choose to make. So I've sort of got off a bit of a tangent, but hopefully that answers your question. Yeah, check.
It's well said. So I just want to add on. Of course, let's say if you have 100K, definitely you will not want to invest 100K all the money into investments. I mean, when I first started my investing journey in 2016, I started with a few $1,000s. Right. The techniques are really simple. Even the things that I shared are simple, but simple doesn't mean it's easy, right? If you read about some investing books, they will say that techniques is about 20%, but 80% is the mindset. So investing is a journey whereby you need to build that kind of mindset, right? How to invest properly. Of course, when you talk about diversification, S&P 500 is the best class to diversify because it comprises of 500 stocks, the best 500 companies in the US market itself. So it really depends on what he said is the risk and reward plus the risk appetite, plus do you have time to monitor. Even Warren Buffett himself, he advocates S&P 500. If let's say you don't have time, just invest and leave it there. It will grow over time.
Yes, I really love the answer. And I believe also the mindset is very, very important, crucial, maybe 80% or more. It depends on the mindset. And the rest could be the tool set and the skill set that you are adding on top. And I believe that when you get started, is the IQ is going to grow a little bit by books, by courses, by advisors that teach you how to do. And then the most important thing is the EQ, how you control your emotions in the market that you see. If you start with $10,000, 10% is $1,000 can go down. If it's $100,000 portfolio, okay, sorry about that. And 10% of 100,000 is $10,000. Can you handle that volatility? When it goes to 1 million, 10% is 100,000. So I believe we need to start in a certain point to get your IQ, then EQ. IQ, EQ to go to the next level, right? Especially with the mindset. Question.
Actually, the tip.
So interestingly, there's a study done by Fidelity, the asset management company, whereby actually people who lose their passwords actually do better in the markets. So there are studies that's done. So I must make a confession that. So I said my investment journey was shaped by the 2008, 2007, 2008. So those who were invested in those times, you know how scary the market was. Unlike the COVID crisis, which rebounded in 3 weeks, it took maybe a year and a half before markets recovered. So I think some of you guys remember that. So those were really scary times. To your question of how do you prevent yourself from exiting the market prematurely, I think the first thing is you need to understand the inherent risk within what you had initially invested in. I think very often people don't understand what to invest in. They listen to like someone else say, oh, this is a good stock pick, and so on and so forth, and then you buy it. It's not necessarily a bad investment, but it might not just be suitable for you from a risk appetite perspective. So I think the first rule of thumb would be to really inherently understand what the investment you're invested in. That's the first thing. I think secondly, having a good advisor comes into play, right? A good advisor doesn't just tell you what good things to invest in. Very often, a good advisor is a good coach for you, right? He or she can coach you to ensure that you're staying invested, not just towards your goals, but during periods of difficulty as well. Just to remind you that, hey, this portfolio, the risk is like this. What's happening in the market, it's nothing to do with the investment. It's just the broader markets. It helps you calm down, and then it helps you stay invested in the market. And then hopefully, maybe double down if it's a good investment, right? So I would say a good coach and knowing your risk appetite, and then investing in the risk-appropriate products will be the 3 ways by which you can mitigate sort of an emotional upheaval during market downturns. Yeah.
Totally agree with what you say. I think at the end of the day, right, it's about conviction, right? You must know what you're investing. Like what I mentioned, MITO, I is the investing into the fundamentals. If you know what you're investing in, even if the market tank, which is quite common, because we can't control the market itself, you will have that peace of mind. The most important thing is don't lose your sleep, right? Over the market tanks. And if you know, right, if you are there for the long term, right? If you are an investor, not a trader, investor as in invest in a long period of time, you know that this company is a good stock that you want to hold for long. You know that over a long period of time, it will eventually goes up. Like the charts that we shared earlier, over a long period of time, good companies, the market will always reward, right? In a short period of time, there's of course a lot of market players, market makers, making, I would say like market manipulators, which is very common. But just invest with conviction. Of course, that is coming with the correct mindset as well.
Can I go with this? Because I cannot hold myself here. I should be asking question, but okay. So I believe also the best investment you can do is within yourself, learning the proper fundamentals, as well as having a great advisor as well on your side, because you cannot cover everything, right? You cannot be in the market or watching the market the whole day. You have to focus building your business, right? That is the main thing. And I believe that if you have the conviction and if you zoom out, right, you will be able to actually handle this volatility, because in the long term, always kind of going up, right? The earning power, the economy, everything is going up. If the revenue grow, or all of these statistics that fundamentals is showing you that it's a great company, then you will be able to invest in. So there will be the diversification or diversification thing concept, right? So if you know how to pick the best student in the 500 company or 500 student of the school, then you will be able to maybe do better. But if you don't, then better maybe to stick into the diversification, right? So it's based on your knowledge level, conviction, and volatility, how you can handle it. That is my opinion.
Sure. I think a short answer, I think it depends. It's about definition. What do you mean? How do you define diversification? So obviously, if you want to diversify, so I can define it from the firm's perspective and the Endowus' perspective. We look at the market cap perspective. So what that means, for lack of a better word, if you are the wealthiest man in the world, you can buy every single security in the world, what do you end up with? Right? So the market cap, right? Everyone not understands it. You end up with a allocation generally 55-60% US. Whether you hate US or not, unfortunately, most of the equities are domiciled in the US. Then the rest is like developed markets, 85%, 50% emerging markets. So that's how we define diversification. It's our conviction, as Jack often talks about, that this is one of the ways by which you can be truly diversified. Now, can one truly be diversified such that there's zero correlation? I think in recent events, it shows that it's extremely difficult, unless obviously you employ like some put options or whatever it is, right, that Jack is great at. It's very, very difficult. So I think, ultimately it's about personal conviction and how you define what diversification is. Yeah, so I know time is running out, so.
Anything last thing?
Yeah.
All good? Okay. So thank you very much, everybody. I believe that, as I say a little bit like information, you want to convert into transformation, but in between, the most important thing is implementation, which is taking action. If you don't take action, whether it is learning from them or doing your own research, nothing is going to happen, right? So we need to take action, keep increasing the IQ, EQ, and then we are going to be all there. Fire voices of fire, and we're focusing on what you really love to do. Okay? Thank you very much, everybody.
Thank you, gentlemen. Thank you so much. A big round of applause for our panel. Thank you. All right. Good news, there's still food, there's still drinks outside, and we are free to mingle and network. I'm just going to close this session, and after that, I hope that you make meaningful connections. We have the space until 9, so do help yourself to the food and drinks. Okay, once again, a big shout out to our partners from earlier on, Gen 5 and Endowus, who are here still with us. There's a team here, so please do engage them to understand how you can get 100% what they shared earlier on. And also a big shout out to N9. The GM is outside, so if you're interested to inquire about their space, do get in touch with her. Her name is Sarah. Okay, and this is us. We are really, really glad that we could have you here today to help grow the startup scene in Asia and also to create impact together. And none of this would be possible without our team of volunteers. We are 100% volunteer driven. ASN team are outside, inside here. Give it up for JC, Sydney. Our other volunteers are outside, and just now you might have heard, Jack is one of our lead volunteers, and this event was conceptualized and driven by him. So we are all here today because of Jack's initiative and her passion. Well done, Jack. Thank you so much. All right. Yes. We will be sending out a post-event summary email, so you can find all our links there, some of the resources from here as well. All right? You can join the community group. It will be inside. Yeah. Thank you so much. All right. Please help yourself to the food. Thank you so much.